Today we're going to be talking about the man who predicted to the 2008-2009 crash, who is now predicting an even larger crash. Now, this guy, when he raised the flag in 2008, 2009, everyone just hated him. They thought he was a lunatic. They thought he was wrong, but he was right. Even his investors, he's basically a hedge fund manager. All his investors, most of them at least, really thought he was idiotic. They withdrew from his fund and they called him uh, someone who really didn't know what he was doing. And they were mad that he wasn't generating results. Turns out he was right. They were wrong. And he was able to hold in there for the long term and make a lot of money from it. Now, you would think that since then, and since, there's even a whole movie made in Hollywood from him, with Christian Bale starring as him for Pete's sake, that people would actually believe him. But turns out there's still a lot of people who are skeptical. Uh, Fast forward many years in the future, when he is now forecasting the next crash. Now, this video is not about stock tips or encouraging you to invest in stocks or uh, borrow or go into debt or play the game. That's gambling and that's very risky. But it is important to inform you of personal finance and just get ahead by learning more about business and stuff like that. Michael Burry, I found out about him from the book, The Big Short, which a movie was subsequently made about that. And that's because Michael Lewis, the author of that book, is one of Warren Buffett's favorite authors. So that's how I found out about it. Hopefully, you'll find this entertaining at the least. Let's see what this guy has to say. He's basically a 70,000 subscriber YouTuber who talks about this type of stuff. I'm going to play it at 1.5 times speed. Otherwise, this reaction video will take 30 minutes to get through.
Michael Burry is one of those investors who isn't in the spotlight very often, but when he is, everybody pays attention. Most people are familiar with Michael Burry as the main character in Paramount Pictures' The Big Short, a true story about how Burry predicted the housing market collapse and the subsequent global financial crisis years before anybody had any clue that it was coming. This week, Burry is back on Twitter sharing his thoughts on the current state of the market, and he's made some pretty scary predictions about what he sees happening in the near future. In today's video, I'm going to be sharing all of Michael Burry's tweets and predictions over the past week, including some that you probably haven't seen because he deleted them just a couple of hours after he posted them. I'm also going to be sharing my thoughts on his prediction. And then I just want to share a short clip of an episode of the Young Investors podcast where myself and Brandon from New Money discuss a pretty funny example of extreme speculation and inefficiencies in the stock market. This is going to be a jam-packed video, so if you do get some value out of it, I would very much appreciate it. Take the 2 seconds to leave a like on the video, and if you want to see more content like this in the future, then consider hitting that subscribe button. But with that said, let's jump into the video. Michael Burry has been using Twitter over the past few years to share his opinion on a variety of things in relation to the financial markets, in terms of his opinion on individual businesses, whether they're in a bubble or undervalued, his general thoughts about the market overall, as well as other things around the economy, interest rates, and inflation. But he actually deleted all of his tweets in April 2021 and went silent for a couple of months. Never fear, because this week he was back and he was not quiet. When he came back, he was tweeting a lot throughout the week. A lot of these he deleted, so I'm going to be pulling them from articles as well as screenshots that I took as soon as he posted them. But first of all, on Tuesday last week, 7 days ago from when I'm posting this video, I think, he tweeted this. People always ask me what is going on in the markets. It is simple. Greatest speculative bubble of all time in all things by 2 orders of magnitude. Hashtag flying pigs.
So I'm going to pause right there just to let you know that this guy's been tweeting for like at least a year, forecasting, this crash coming. And I think the public at large doesn't care. You would think like, okay, this guy's been right once. Maybe this time we should listen more. And some people are, but I think maybe it's human nature. People don't want to believe it. It's a good time right now. We just came out of the pandemic. So they don't want to believe that. So it's interesting. I remember when I heard about the 2008, 089 thing and how he bet big and he profited from the crash through basically shorting the market, the housing market. I was like, if I was if I was like old enough then, I would have like followed him and then made some money too and not been a sucker, but easier said than done. Here we are again, and yet, even I am a little skeptical of it. Not much. I think he's right, but it's like it's human nature to go with the crowd.
Pigs 360. And there's not too much reading between the lines that we need to do here. It's pretty obvious what this tweet means. It means that he thinks that there is speculation in many parts of the markets, if not all parts of the market currently. And I think most people are interested in figuring out what that hashtag means. That was kind of the most cryptic part of his tweet. And the conclusion that I drew, and there are differing opinions, but I think he's talking about the fact that there's a saying in the markets that bulls make money, bears make money, but pigs get slaughtered. And it's basically a saying that suggests that if you're greedy in financial markets, it is going to come back to bite you. And that makes a lot of sense considering he thinks that there is a significant speculative bubble going on in a number of different parts of the financial markets. Burry
I think it just means that pigs are flying now. We're in a very imaginative, speculative state.
and deleted this tweet almost immediately and followed it up a couple of days later with a few more tweets, which he again deleted. So all of these tweets that I'm showing you are not actually available anymore, but these were the follow-up tweets that he sent on Thursday. All speculation is doing is drawing in retail before the mother of all crashes. FOMO parabolas don't resolve sideways. When crypto falls from trillions or meme stocks fall from tens of billions, Main Street losses will approach the size of countries' history and
I'm surprised he didn't mention NFTs. I think that bubble is bigger than crypto right now. I mean, the speculation there, like hundreds of thousands of dollars for a digital monkey. And I went to an NFT event in New York recently just to ask a lot of the networking and people there just to get a sense of what they think it is. And there is some relevance. You get an exclusive events as well, but is that really worth hundreds of thousands of dollars? Maybe one day, but for a monkey, for a digital monkey, I don't think we're there yet. I think we're very in the speculative bubble. By the way, guess guess what type of demographic makes up these NFT events? Young men, not the group most representative of wealth.
history ain't changed. This tweet is pretty similar to the previous one, except he's explaining a little bit more about how the bubble will probably end up unraveling. First, he's saying that it won't resolve sideways, meaning things that go up extremely quickly usually come down extremely quickly, and that's kind of the bubble pop that everyone is expecting to happen. And the other thing that he's talking about here is the fact that the speculative bubbles usually start to break or weaken or pop at the most riskiest parts of the financial markets. And I think it's quite obvious that that currently, at this moment, is parts of the cryptocurrency market. So at the very, very extreme, you have these altcoins or these scam coins that you have now rappers promoting for money on Twitter, which is just ridiculous. Then you have more mainstream cryptocurrencies, the largest cryptocurrencies, but then from there, that's going to flow into high risk growth stocks that really don't have any profits yet, and things in the stock market that are looking extremely speculative. And that again will probably flow into all of the other businesses that have also seen massive increases in their prices, a lot of it being extremely unjustified. He went on to say, the problem with crypto, as with most things, is leverage. If you don't know how much leverage is in crypto, you don't know anything about crypto, no matter how much you think you know. Knowing saves half the battle. Got it? It's not hard. Analyze, think independently, be informed, find data, and you'll know a lot no one
So he's giving free advice here, and yes, he keeps deleting his tweets, but it's worth paying attention to.
else does. In terms of that second tweet, I have no idea about the crypto market and how much leverage is there, but it would not surprise me to know that there is a huge amount of leverage there, considering high returns generally attract riskier and riskier investments, and along with that comes people using things like margin or other types of loans in order to amplify their returns. I think the last tweet that he made there
You
of that
got to be careful about, like, don't take any debt that you're not sure you're going to pay back. That's something Warren Buffett does. Remember the kid who borrowed heavily in Robinhood a couple years ago, ended up killing himself because the stocks went the wrong way, and then he ended up owing hundreds of thousands of dollars. You got to be very careful with that.
there of that group is really, really valuable because it is super important as an investor, if you want to do well, to think independently. Because at the end of the day, whatever is consensus is priced into the market. What everyone agrees on in terms of available information and what businesses are going to do in the future, whatever is agreed on is in the price of the business. You can't use that information to outperform the market. You need to be betting against the consensus in some way or another. For some people, like Michael Burry, he likes to dig into numbers that are there, information that is there, but that people are not trading on or that people have not seen yet. For me personally, I'm not that good at going into extremely detailed data for things like leveraging crypto or the housing market, for example. But what I do is I find businesses that people aren't interested in because they're expected to have a bad 1 to 2 year period. Either way, whatever you're doing, you need to be betting against what the consensus or what the market wants. And in my case, I don't need to trade on information that isn't publicly available because I'm able to invest in businesses that people just aren't interested in, because most people want to make money in the stock market in the next 1 to 2 years, and that includes big institutional investors which move most of the money around in the markets. In terms of my thoughts on his predictions, I don't understand everything in financial markets. Obviously, I don't think anybody does. So for me to make a prediction about how everything is going to change in the future or whether everything is a bubble and everything is going to collapse, I just don't think that's realistic. But in terms of the few businesses that I do look at and that I do understand, I'm seeing very, very expensive stock prices relative to any time over the past 100 years. And that tells me that it's very, very likely that what I'm seeing in areas I do understand is likely what's happening in areas I don't understand. And at the end of the day, what I'm happy to do is invest in businesses that I understand if they're at good prices, and if they're not, I will wait patiently for opportunities to arise. Now, with all this talk of speculation, gambling, and ridiculous things happening in the stock market, I just want to share a short clip from one of the recent episodes of the Young Investors podcast, which is the weekly podcast I do with Brandon from New Money. In this episode, we discussed an extreme example of market exuberance, and this segment ended up being pretty hilarious. Also, if you want to catch the full episode and all of the other episodes, you can either on YouTube, Spotify, or iTunes, and all the links are down in the description below. We'll start off with a bit of a light-hearted.
I know the headline. You said the headline to me, but I've deliberately stayed away from all information around this story because I want my reaction to this story to be genuine.
Yeah, so
and it sounds like it's going to be something crazy.
Yeah, I mean, look, we'll see, but I think this story is a very good example of, if you ever needed any more evidence that there is irrationality in the markets at the moment, this is like this is like the pinnacle of irrationality. Like,
Yeah.
if you think Tesla's stock price is irrational or like GameStop's short squeeze is irrational, just wait till you see
Yeah.
what's going on with
Who
this
was it
company.
that was coming out talking about irrational exuberance recently? Was it Monish or was it Charlie? I can't remember. It was
I
one of
mean, Charlie had his daily journal thing where he spoke about irritating bubbles and that sort of
yeah,
thing.
yeah.
It's probably all of them.
Probably all of them at the moment. Yeah,
Yeah.
exactly.
Anyway, but this one was from David Einhorn, who he does describe himself as a value hedge fund manager. He has like a long short portfolio. So
Okay.
I think Joel Greenblatt does this as well, where they're a value investor, but what they do is they like have like a system where they can assess every stock and then they go long on the stocks that are undervalued and short on the stocks that are overvalued. So it's a long short portfolio.
Right.
But he releases a quarterly letter detailing the results for the hedge fund, and then he also just talks about the general market as a lot of these investors do, kind of share their opinion and stuff on the market.
Yeah.
And in this letter, he was talking about the kind of exuberance of the market.
Right. Okay.
And he drew to this example.
Let's get on with it. I've been wanting to hear about Michael Burry or this headline for like the last 3 minutes. Like, cut this out. Like, get to the point.
Which is kind of hard to believe when you go through it. So he spoke about a company called Hometown International. Have you heard of it?
Aerodyne. They make next generation satellites or radar detectors. I don't know.
I mean,
huge military and civilian applications.
I mean, you joke about that, but this is literally the real life equivalent of that. I kid you not.
All right, hit me.
It's kind of unbelievable.
All the dudes look very similar.
Hometown International is and I'll say this in a very investor way. It's the parent company of a New Jersey deli.
Okay, all right, like a deli, like meats, cheeses.
Correct.
Like
yes.
A deli.
And this isn't a chain of delis across the United States or the world.
Right.
This is a single deli.
Right. So this is the deli at the end of your street.
Yeah. So
in your local shops.
Correct.
Right,
Yes.
okay,
And
okay.
it's it looks interesting from the front. You should go look this up on CNBC. Look up the story after you hear this. And it is a single deli that decided to list on the stock market.
Wait.
Which, first of all, that's just a little bit ridiculous.
How do they even do that? Do they IPO this thing?
I don't
I guess it's just like a direct listing. We'll talk about direct listings a little bit later.
Mm.
Does a company just like, hey, I don't even know if I had a deli or any shop for that matter, I want to go on the stock exchange. You'd be laughed out of an IPO. Just like, what do you do? Do you apply for a ticker symbol and then you're on?
I don't know. I mean,
have no idea.
Yeah, I believe it trades over the counter, so you can't just like trade it on most brokers. But
Okay.
it is
Anyway.
listed on the stock market, and it's a really great business.
Revolutionary founder
yes.
takes his deli business public.
Yeah,
What happens next?
We took it public in 2019, and if you look at the annual reports over the past 2 years,
Yes.
the deli has produced a total combined of $35,000 in revenue.
35,000 over the 2 years.
Correct.
2 years or two and whatever. Around about 2 years.
Yes, about 2 years. Yeah. So the CEO is also the CFO, the COO, the treasurer, and the sole director.
Oh, I love this guy. What a legend.
And on top of all of those responsibilities, so
Yeah.
he's managing a huge company, 35,000 in revenue over 2 years. He's listed on the US stock market. On top of all of that, in his part time, he's also the wrestling coach of the school next door to the deli.
Oh, this just keeps getting better. All right, so we got this macho guy that runs a deli that's made 35 grand in revenue.
Yeah, part-time CEO of a massive corporation, massive global corporation, part-time wrestling coach for the school next door to the
I mean, he needs to like start it strong. Like, he's really mulling this out, stretching it out. I mean, you get to the point, like, is the stock price for this thing just like shooting to the moon? That's what you should lead with, not just keep continuous roll on about this deli guy who's a wrestling coach part-time. Like, what's the point?
All right, yeah, sure.
So I thought we could do a bit of evaluation on this company. We
Okay.
can kind of feel around and kind of see what it's worth, because maybe we want to invest in. I mean, it's public.
So I think that's it. Yeah, long story short, there's been a lot of videos coming out with Michael Burry. I was hoping this guy would talk a lot more about his other tweets, but I've seen some of his other tweets, and it's pretty darn interesting, a little scary too. Let me see if I could pull another one up, because I think this is important to check out.
Hey everyone, and welcome back. One of my favorite things to do while in the finance space is to keep up to date with what and to his take. Has been one of those periods where Michael Burry has gone on a rampage talking about a bunch of different topics, from cryptocurrency to passive index fund investing to his take on the Evergrande situation that's unfolding at the moment in China. So in today's video, I just want to go through some of the tweets that I thought were more interesting and share my thoughts on them, share my take on some of his opinions and what he sees, takes all of Michael Burry's tweets and keeps them there forever, right? Even if Michael Burry deletes things, the internet is forever. So today is one that he posted on the 19th of September. And in this tweet, he talked about how for every $1 that has been invested in the stock market, it has generated a $5 increase in the market value. And he links a research paper to support this finding. He also says that 90% of millennials, aka the future wealth owners, are in passive market vehicles. That 5-to-1 ratio will get much bigger, much sillier in time. COVID didn't stop it. Inflation might not. What Michael Burry is talking about here is how it is super mainstream right now, particularly among young people just getting into investing, to invest through index funds, to just passively invest by buying the entire market. Because if we look at what an index would have done over the past 100 years, say for the S&P 500, which the S&P 500 index has not been around for 100 years, it's only been around for about 20 years. But if you assume or pretend that it did exist for the past 100 years, then you would have made about a 6 to 8% return after inflation if you were investing over any 20, 30, or 40-year period during that time. And what a lot of people have done now, and I'm certainly guilty of this to an extent, is taken that historical data and assumed that that will happen in the future regardless of what price you're buying those index funds at. And the dangerous mindset behind that is it gets very much into the idea that, or many of the ideas that created the housing bubble in 2008, which was that people believed that housing could only go up, that it was super solid, and that it didn't matter what price you paid for your real estate, that you would make money on it.
Yeah, so this is something that if you're old enough to be into investing, it's something to look out for. And a lot of people, they don't know what to park their retirement money into. So they put that through their 401k, their Roth IRA, into an index fund. And generally speaking, that market index fund is a sound strategy. A lot of people try to get fancy and try and do these risky stocks and so forth. But I've read a lot of books on this, uh, and John Bogle is a great place to start. But Warren Buffett's talked about this a lot too. The vast majority of professionals fail to beat the index, and that's just like the uh, aggregate uh, average returns of the generally the top 500 companies in the U.S. Now, even the ones who do beat the index, they're usually not the same ones the next year. So it's very inconsistent. Most people fail, even these people with millions of dollars and hundreds of analysts on their team. So it just goes to show you how hard it is to beat the stock market index. And so, generally speaking, it's a wise idea to put it in. Now, what this guy is saying is basically that, uh, at least in this period, people are finally getting their head on right, and a large portion of them are realizing the power of an index fund and putting it in there. In general, this is a solid formula, but in this small time and age, this short time and age, it's become not so wise because so many people piling in blindly has just pumped up the price to a point where it may not be the most sound investment. Maybe, more safer investments, while they may not return as much, like bonds, could just kind of help help you be more diversified because maybe a crash is coming with these highly overvalued. Like the more people dump it into the index, the higher the price, the higher the valuation, and then potentially a crash comes when the price doesn't equate to the actual value of the assets, the businesses. Uh, in general, and I think this guy did another video who talks about this. I think, well, there is some truth here. In the long term, we're talking decade long. Uh, Warren Buffett still believes in index. I do too. So you got to be careful in the short term. We're talking the next 5, 10 years. But if you're going to park this money till you retire, like 40, 50 years from now, in that long of a time frame, usually the index continues to do well.
Money on it. People were buying it with the intention, with the belief that it would just go up, not looking, rather than looking at the fundamentals of that property, which would have been what rental yields could it actually generate. And a similar thing is happening in index funds, where you have massive amounts of money from young people, particularly, flooding into the markets and investing in businesses without considering the price of those businesses, right? And that, of course, inflates those business prices relative to what those using. And when you're index fund investing,
Yeah, so that's what he's basically saying. Like the index, people just blindly, especially young people, blindly putting it into the index. Price is just going through the roof because of that uh, high demand, that hype. And while it does return well, once you just the sheer volume of it gets high enough, the prices don't match the assets. Now, like I said, and this guy, he says it in another video, that is a thing that is something worth considering in the short term. Uh, there may be a crash, a price correction in the next 5 years or so. But then I think in the long term, and we're talking the Warren Buffett level, 10, 20, 30, 40, 50 years in the future, uh, the index will kind of continue to outperform other things. And that's really what we're talking about when we're talking about the power of an index fund. And so many people failing to beat the market. So if you're able to hold through the ebbs and flows, I think index is still a sound strategy. But I think in the very recent times, people have just been piling too much in it. So there might be a correction soon, and once it drops and crashes, uh, that might be a time to get in on it at a better price.
fund investing, you're just not doing that. Burry goes on to say that the first step is to recognize that 5 to 1 is not a natural ratio. It's a product of a paradigm. So what will continue this paradigm? What may reverse it? This is a knife's edge because we are 5 to 1. It may go to 100 to 1, or it could become -5 to -1, but parabolas don't resolve sideways. And I think this is a really critical thing to understand, right? If it is true that index fund and passive investing, people just investing blindly basically into the markets, if it is true, and it seems to be true, that it is pushing up the market, the value of markets, or the value of stocks far higher than the amount of money that is going in, then the same thing could be true on the other side, right? If there is widespread panic and a lot of people are pulling out of passive investments, they're pulling out of index funds, then that's investor dollars coming out of every business, pulling everything down. And it could very well be the case that a similar trend is seen on the downside, that for every dollar that is removed from the market, from a passive investment, for example, that the market value of stocks will go down $5. And that could mean that while the market has gone up at a huge rate over the past few years, an absolute unprecedented rate, the opposite could also happen. We could have an unprecedented decline in stock prices that we've never seen before. So what are my thoughts on this? Well, I do like index funds as a foundation of my portfolio. I keep about 10 to 15% of my portfolio in index funds at all times. So I do like them as a vehicle to invest broadly into the market, but it is certainly not the majority or the most significant way that I invest. The most significant way that I invest is looking at individual businesses where I can assess future cash flows for those businesses and make rational decisions about when I should invest in those companies.
Yeah, so I would caution against, once again, any type of individual stock investing or gambling. That's a profession in and of itself. And like I mentioned, people paid millions with hundreds of analysts on their team still fail to beat the index. So I don't necessarily agree with his strategy for the masses. Maybe it works for him if he thinks he's good enough, if he can prove it. Um, but for the average person, I think the main takeaway is a crash is coming. Index funds in the long run, and we're talking 30, 40, 50 years, uh, they generally do well. They consistently beat professionals. Uh, but in the short term, in short term for me, is like still like in the next 5 years or so, we do have an overvaluation and an impending crash, potentially the largest crash we've seen. And that's when people will panic and they will panic sell out of the index. Uh, and so I think there is an ebb and flow where an index fund is a very solid strategy. And that's why Warren Buffett has recommended for decades that if you just park 90% of your retirement money in an index fund, you'll do better than uh, most people. And he's done a lot of things, stats to prove it. He even did a bet with a hedge fund. You can find that I think at longbets.org to prove it. He did a 10-year bet and I followed it for all 10 years. And he was like, I'm gonna show you the power of index fund. And he opened it to any hedge fund to challenge him and say like, I'll donate $1 million to a charity if you think you can beat the index fund. One hedge fund finally took him up on the offer. It was it was something I followed every year. And sure enough, there's a couple years where it was close, but then index pulled way ahead. So you just see the power of the index, and I think the issue is that potentially, finally, maybe through all the personal finance YouTubers and bloggers, people are getting their heads on right and investing in index funds. But I think it only works when a certain limited amount of people invest in. Perhaps that number is excessively high for the moment. But in general, I still fully trust the index fund in the long term.
Those companies, when I should hold on to them, and when I should sell them. And if you're interested in for inflation and the outcome for you, meaning that they gauge for they wanted to be able to talk about inflation in the way that they want. Burry shared a screenshot from a Wall Street Journal article which talked about how Jerome Powell, the head of the Federal Reserve, was using a gauge for inflation that gets rid of the top 31% of the measures and the bottom 24 of the measures, essentially meaning that they are leaning on the downside when showing their figure for inflation. And the outcome for using that figure, where they took out the top 31% factors and the bottom 24, was that the target was exactly 2%. So what Burry is saying here is that it's very, very convenient that they used this measure that removes the 31% of the worst inflation numbers, the highest inflation, but only 24 of the bottom ones, and the outcome was 2%, which is the Fed's target. He thinks it's very, very convenient that they're doing it in this way, and believes that they're trying to downplay inflation, which I think is exactly what they're trying to do. They don't want widespread panic. Even if inflation is a little bit higher than 3% and it's not actually too much of a concern, if people know that it's above the target, then people might panic, and that might cause a significant sell-off in the markets. It's no surprise to me at all that the Fed is doing everything in their power to be very, very careful with what they say and what data they release to try and keep fear out of the market while they go through this monetary policy change. Because the reality is they are going to have to start pulling back and tapering and restricting some of their monetary policy, which has been extremely loose, extremely generous to markets over the past 18 months in particular. They're going to start to wind some of that in, and they have to do that while not making the market believe that inflation is overheating and that the economy is overheating.
Yeah, so I'm going to end it there. I think one of the big takeaways after watching a lot of these Michael Burry videos is that this is a guy I want to keep tabs on because he is very smart. He predicted the 0809 crash. Now, the thing is, what he's basically predicting this time is the biggest crash of them all and hyperinflation happening, which means that the $1 you earned at work, it could be worth less than 50 cents within a year or two, just because of the amount of money printing going on and all the other stuff on a macroeconomic level. Now, I'm not smart enough to predict the future, neither is this YouTuber, maybe not even Burry. as Warren Buffett says, he doesn't know what's going to happen on the macro. He can't predict the future. He says he makes his investment decisions using microeconomics, finding good businesses, good areas to invest, regardless of the macro trends. Obviously, paying attention to them, but not using them as predictors. So, I think what that means for us is essentially that things may change. Is there something we can foreseeably do to profit from this, to protect ourselves, to hedge ourselves? I think, you know, what Warren Buffett does, what some of these people do, we can't necessarily clone, as in we can't invest in uh, inflation proof businesses like them because we're not investors. We can't really find those like they do. I think what we can do is we can protect ourselves. We can be ready for when that happens so we're not surprised when there's a huge crash, even though the pandemic just happened. We don't get scared off or crazy when the hyperinflation starts happening. And when that time happened, and it's happened in the past, I think in like the 80s or 70s, there was rapid inflation as well. And really, the best hedge for that is constantly investing in yourself, in your skills. Inflation can't take that away. If you're able to output a certain level of skill set, a certain quality of skill, like as a software engineer, they're still going to pay you the market inflation adjusted rate. So as a professional, as a individual, you need to once again focus on developing yourself. If you're not an investor, if you're not a stock picker, that's the best way. Invest in yourself, as Warren Buffett says. Whether you're an artist, a graphic designer, up-leveling your skills will keep pace with inflation. If you want to get into retirement and stuff like that, it's hard to say. It's hard to say what to do. Uh, Maybe lay off a bit on the index funds. Uh, Maybe put more in the cash because essentially what you can do once the crash happens, once hyperinflation does happen, is take that cash, buy into an index fund then when after the crash happens. Now you're buying that index at a much cheaper price when everyone's pulling out. And so when it rides up and goes from there and beats all the professionals, then you can make the gains. Then you're out of cash since inflation isn't eating your cash anymore. You've now turned that into index fund investments, as in investments in ownership of actual high performing businesses that are usually more inflation proof. So I think that's the general thing you can do. No use trying to pick individual stocks or bonds. That's a very complex game that I can't do, that many professionals can't. So I'll stop it here. Thanks for watching. I know, kind of random, but something I'm interested in. Hopefully you found it entertaining at